Hello everybody, welcome to our channel Strategic Tutorial. Today we will discuss inventory. Inventory is one of the most important components of the total cost. It comprises around 25 to 30% of the total cost. So there are so many ways and so many types of calculations of inventory valuation. So today we will start our new topics, inventory valuation. So this is the inventory, you see, alternatively known as stock in trade. We are habituated to talk like stock in trade. Inventory is the largest asset of total assets of the company, which comprises 25 to 30% of the total assets. In trading business, inventory includes all goods for sale. In manufacturing business, inventory may be segregated in the following major forms of stocks. Number 1, raw material. Number 2, work in progress or WIP. And third one is finished goods. So these are the different stages of stocks we are maintaining in any corporate sector. According to the accounting standard for valuation of inventory as per AS2, as issued by the Institute of Chartered Accountants of India, objectives of the valuation of inventories in the proper determination of income through its matching appropriate cost. Now, valuation of inventories as per AS2, the main characteristics has been described, that is finished product held for sale, in the process of production, that is remaining in the production floor, that is semi-finished goods basically. In the form of raw material and supplies, these will be used in production. This is the finished stage. For valuation of inventories, cost or market price, which is less. This is the most important and this is the thumb rule of valuation of stock. That is cost or market price, whichever is less. That is the mode of valuation. Now I am coming one of the parameters, that is net realizable value or NRV. Estimated selling price less cost of production, cost of completion basically, and cost necessary to make sale. So estimated selling price, I am telling you through an example. Here I have mentioned one of the example, you go by that only. ABC Limited has an item which cost of 15,000 rupees. Selling price is 20,000 rupees. For selling, you have to incur some expenses for suppose like modification cost 3,000 rupees, selling expenses 1,000 rupees. So net realizable value should be sale minus other cost, that is 20,000 minus 3,000 minus 1,000. So it is coming 16,000. Another example. B has a contract of supply of 1000 kg of sugar to his supplier at the rate of 25 per kg. The contract price is fixed for 3 months, that is July to September 2020. At the end of September, the market price has gone up to 30 rupees 30 per kg. Selling price is 2,000 rupees. D buys 1000 kg of sugar at the rate 30 rupees per kg. So, calculation of fair value should be 30 rupees per kg, 1000 kgs he buys. So total purchase value will be 30,000 and NRV is 25 rupees per kg into 1000 kg, that is 25,000 less selling price 2000, so NRV will be 23,000. Coming with the next example. Stock which cost 30,000 can be replaced by 22,000. Here one new parameters has been inserted, that is a replacement cost 22,000. Estimated net realizable value of the above stock is 18,000. So proposed that the stock should be written down to 18,000. Give your opinion. So your opinion, the thumb rule is cost and net realizable value which is lower. Here cost is 30,000 and NRV is 18,000. NRV means net realizable value. 18,000, so stock should be valued at rupees 18,000 only. Now I am coming another parameter is replacement value which will not be taken into consideration. It is as per AS2. Cost of purchase. Cost of purchase is also one of the most important parameters for valuation of inventory. Purchase price of the product, I have given some one example, 100 rupees. You have to add duties and taxes. It may be import or export duty and GST and others, the tax part. So you get the subtotal and add the freight, inward and brokerage charges, packing cost, etc. So you get the subtotal of 223. Less trade discount, rebate, duty drawback. We are getting some input tax credit also. So you can make the deduction of that and ultimately you get the cost of purchase. So this is the way of doing cost of purchase. Now I am coming cost of conversion. Cost of conversion is including the costs that are directly related to production, such as direct labor. These production overheads are segregated into fixed and variable. There are two types of overhead, fixed and variable. Now I am coming the example with fixed production overhead. A Limited has a normal output of factory is 15,000 units per month. Per unit overhead rate is 20 rupees. A Limited has received a special order of 3,000 units from USA. After making an arrangement of the overtime, the new level of output has increased to 30,000 units. Earlier it was 15,000, just double. It has increased, production capacity has increased to 30,000 units. Total fixed overhead per month 15,000 into rupees 22 rupees 3 lakhs. Under revised circumstances, revised overhead rate should be 30,000 divided 3 lakhs divided by 30,000, so rupees 10 per unit of overhead. Now I am coming to the variable production overheads. This is assigned to each unit of production on the basis of actual consumption of production facilities. Example, Raymond's Limited is a garment manufacturing company, has its centralized washing facility. It costs 900 rupees per productive hours to run. One tracksuit takes 5 minutes for washing. So overhead per tracksuit is rupees 900 divided by 60 is equal to 15 per minute. Hence the overhead per tracksuit should be 5 minutes into rupees 15, that is 75 rupees. Another stage of inventory, this is most important, that is joint products and byproducts. There are certain stage of production. Suppose product A and product B, it produces after mixing that the joint product is product C, like that type of things, and how we do the valuation of that product. So example is Indian Oil Corporation incurs per batch of joint product cost of 60 lakhs. For the production of two joint products A and B, both the products can be split of point. It is very important, split of point should be there. These can be sold A rupees 50 per unit, B 40 per unit. So production was A 40,000 units and B 25,000 units. So the joint cost can be allocated of rupees 5 lakhs like this. That is 40,000 into 50 rupees, that is 20 lakhs. And another is 25,000 and into 40 rupees, that is 10 lakhs. So total sales 30 lakhs. So A and B, the ratio is 2:1 basically. Joint product cost will be segregated like this. 60 lakhs into 2/3 of 60 lakhs and similarly 1/3 of 60 lakhs, that is product A and B. So per unit cost should be 40 lakhs divided by 40,000 is equal to 10, and per unit of production cost per unit of B should be 20 lakhs divided by 25,000, so 40 rupees. Sometimes inventory valuation is complicated if the item costs are varying, and two methods are very useful, such as FIFO, first in first out, and weighted average method. So what is the example of FIFO method? I am giving some example of doing FIFO method, that is first in first out. So following transactions are extracted from the books of A Limited. Opening stock 5,000 rupees, that has been purchased in rupees 35. Here the rate is very important. And in January 3rd, purchased 2,000 units at the rate 38. There is a sale 3,000 units on 5th, 1,000 units on 8th. On 12th, again purchased 4,000 units at the rate of 40 rupees. Next, 20th, there is a sale of 3,000 units. On 25th, again purchased 5,000 units at the rate of 22. And finally, on 30th, the sale of 3,000. So, what is the closing stock valuation under FIFO method? Here is the chart. This is the store ledger basically under FIFO method. On 1st January, you see there is a stock of 5,000 rupees at the rate of 35, so 1,75,000. On 3rd, we have purchased 2,000 units, that is 38 rupees, that is 76,000. So, in stock, both stock you have to sort simply because the rate are not equal. There is a set of purchase of 5,000 rupees, 5,000 units at the rate of 35. Another is 2,000 units at the rate of 38. On 5th, there is an issue of 3,000 units. Rate was 35, so 1,05,000 we have issued. It should be minus from the first one. That is the concept of FIFO. That is first in, first out. So 5,000 was first in, and it should be whatever the issue should be there, it should be deducted from the first one. So balance 2,000, that is 35 rupees, 70,000 rupees is there, and another 2,000 it is remaining as usual, that is 38 rupees, 76,000. Similar way, you please go on that, and finally you will get that 1,50,000 is the stock price. If we go by weighted average method, the same example I have shown in weighted average method. So weighted average on the first day it was 5,000 rupees, 5,000 units, rate was 35, so 1,75,000, that was the stock value. On 3rd we have purchased 2,000 units at the rate 38 rupees, so 76,000 amount we have purchased. So it will club with the earlier one, so total quantity 7,000 rupees and the total value is 2,51,000. So the average price is 35 rupees 86,000. So like this you have to go and you will get the closing stock valuation 1,75,290. I have given the formula of weighted average cost. It is the opening value of inventory plus purchase value divided by opening inventory quantity plus purchase quantity. It is one of the another parameters, that is contract price and market price. ABC Limited has purchased 10,000 units of product at the rate of 80 per unit on 1st January. Closing stock on 31st March 2000 units. Out of these, 500 units are earmarked against sale of contract price rupees 100 each. The market price of the product has dropped to rupees 75. How the closing stock will be valued on 31st March 2020? So I have given you the solution. Inventory held against contract 500 into lower cost is 80. Out of 80 and 100, so 500 into 80 is equal to 4,000 rupees. Inventory for resale 2,000 rupees minus 500, so 1,500. Lower cost out of 80 and 75, so 75 is the lower one, so 1,12,500. Total value of inventory 4,000 plus 1,12,500, so 1,16,500. This is the most important, and finally I am giving you, generally we are facing this type of problem for valuation of stock at the end of the year or at the end of the any period. Suppose the closing date, that is the 31st or 30th of each month or quarter or year, but we have not taken the stock valuation on the same day. We have to do this exercise on later date, May after 15 days, after 10 days. So how you will calculate the closing stock? This is the formula. It is very much useful for everyone. So you just go about it. So start with the value of stock on later date. So if you start on 15th April and you are doing the stock valuation of 31st March, so you will take the stock of 15th April. At sale, at cost price only, no margin, and it's not added with profit, only cost, sales cost between current date and closing date. That is the difference between 31st March to 15th April. Purchase return, add during the period, add any undercasting or in stock, add goods in transit. Now we have to less purchase between two dates, less sales return at cost, less overcasting of stock, less goods held in consignment basis, less goods in stock but title transferred to buyer, goods in stock but title transferred to buyer. That means some invoices are already generated but stock has not been delivered. So from this formula, you will get the correct inventory valuation. Hello viewers, hope you have understood the inventory and get some idea regarding the inventory, simply because I have explained the various stages and their calculations in different way. In all competitive examinations, there are lots of questions are coming through inventory and its valuations only. So you should watch this video from start to end, and so that you can get the full idea of inventory and what is inventory and how it's doing these valuations and all these things. So hope you have watched and you have understood this properly, and thank you very much for watching my video. Thank you.